Hi, and welcome to the We Gonna Make It podcast show, where we talk about all things business in Web3. In today's episode, we'll be discussing the US government's recent decision to guarantee all deposits at Silicon Valley Bank and Signature Bank of New York. These banks have been shut down by regulators, and the Federal Reserve had announced the creation of a separate lending facility to protect other banks from ripple effects and prevent bank runs. So why did the government step in? Silicon Valley Bank's customer base consisted of venture capitalists, startups, and other firms across the technology sector. Still, more than 90% of SPV's deposits exceeded the $250,000 limit for federal insurance on bank accounts, and many depositors faced the prospect of losing very large amounts of cash. This could lead people to pull money from those institutions, causing more bank runs. Federal officials realized that business executives across the country might simultaneously decide to move their money to a bigger Wall Street bank. This could have destabilized the smaller banks even further. So they decided to act before the banks open on Monday itself. The government's rescue plan aims to short-circuit the logic of a bank run and restore depositors' confidence that their money is safe. The Federal Deposit Insurance Corporation will guarantee all deposits at SVB and Signature Bank, even those above the usual $250,000 limit. SVB held roughly $150 billion in uninsured deposits, and Signature Bank held more than $70 billion. Those customers will be able to access all their funds now, even though the banks have collapsed. This sends out a strong message that the customers have no reason to move their money because they won't lose if their bank goes down in the first place. The government also tried to ensure most banks don't get close to failing. So the Federal Reserve has announced a new special lending facility with unusually generous terms. It will loan money to banks that put their asset up as collateral, even if those assets are worth less now than what the bank paid for them. Typically, the central bank only lends against the current value of the bank's asset. The move means banks shouldn't have trouble getting access to cash, even if customers start withdrawing funds. Many have questioned whether these actions amount to a federal bailout. On a call with reporters, a Treasury official emphasized that federal intervention would not bring SVB or Signature Bank back to life, as the enormously controversial bank bailouts during the 2008 financial crisis had done for banks that were close to failing. Their executives would not retain their jobs. These new safeguards were aimed at protecting people and businesses who have made a reasonable decision to put their money into an accredited and regulated bank, not investors who bought risky securities. So summarizing, the recent bank failures of Silicon Valley Bank and Signature Bank of New York had sparked fears of potential crisis. The collapse of Silicon Valley Bank could have triggered a much broader financial crisis, with many companies and depositors facing the prospect of losing large amounts of cash. To prevent bank runs and restore depositors' confidence, the government stepped in with a rescue plan that guaranteed all deposits at the failed banks, even those exceeding the usual $250,000 limit. The Federal Reserve also announced a special lending facility to prevent other banks from failing and to ensure that most banks don't get close to failing in the first place. While some economists argue that these measures amount to a bailout, the government officials emphasize that the funds used to reimburse depositors is paid by the US banks and not taxpayers. The depositors were being protected, not the banks, equity, or bondholders. The government's response to the bank failures raises questions about federal response to such crises and whether stronger rules and regulations are needed to prevent these kind of failures in the future. The recent events also highlight the importance of having a strong and stable banking system, especially in the technology sector, which plays a crucial role in the US economy. Alright, before we wrap this up, I'd like to talk a bit about the challenges with the banking industry and how crypto can help. So, in recent years, the banking industry has faced several challenges, including the potential for banks to fail. When banks fail, customers can lose their deposits, leading to significant financial hardship for individuals and businesses. However, the emergence of cryptocurrencies such as Bitcoin, Ethereum may provide an alternative to traditional banking systems. Cryptocurrencies are decentralized, meaning they operate independently of banks and governments. Transactions are validated and recorded on a public ledger, providing transparency and security. Furthermore, cryptocurrencies allow for a peer-to-peer transactions without the need for intermediaries such as banks. This potentially can reduce transaction fees and increase financial inclusivity, as people without access to traditional banking services can still participate in financial transactions. While cryptocurrencies are not without their own challenges, such as volatility, regulatory issues, they offer a unique opportunity to address some of the problems with traditional banking systems. As technology continues to advance, it will be interesting to see how cryptocurrencies and traditional banking systems will coexist and evolve to meet the needs of customers. That's it for today's episode of We Gonna Make It podcast show. Stay tuned for more insights and analysis on the latest developments in the Web3 industry and beyond. Don't forget to subscribe to our podcast and leave us a review. Thank you for listening and goodbye.